Good morning. While this week's events have been completely overshadowed and overtaken by the escalating Indo-Pakistan conflict and war, if you may call it, I still think we should go through a few of the important events that have been happening in the earlier part of the week, and then we come back to what's happening on the ground here and how it could be impacting our markets. So we start with the legendary Warren Buffett deciding to retire finally. He has spent almost 60 years at the helm of Berkshire Hathaway. And now at the age of 94, he has decided that it's enough. He should call it a day and hand over the reins to his successor, Greg Abel. Greg, of course, has been getting trained under Warren for so many years, and he's the ideal candidate to be taking over Warren. He would probably bring in a blend of his style along with maintaining Warren's and Charlie Munger's style that has propelled Berkshire to the heights that it has already here. But possibly there is a change in style that is required because the environment under which Warren Buffett was able to grow Berkshire a little different from the environment now. Let's examine what these could be as we go through the articles here. But more important, between 1965 and 2024, Berkshire's stock price posted a compound annual growth of 19.9% per annum. It outperformed the S&P, which rose only 10.4% per annum, including dividends. So that's almost double the growth of the index, which is what the Berkshire Hathaway stock did. But I must point out that there have been phases where it just mimicked the index. There have been phases where it heavily and fantastically outperformed the index. And there have been phases where it has underperformed the index. So in totality, the stock has been a net winner, but in parts of it, you may have been satisfied or really not satisfied. Especially in the last few years, a time when tech stocks have been leading the growth in the S&P 500 is where you would see Berkshire's underperformance because Warren Buffett did not believe that these tech stocks offered value and never bought into them. And by his own admission, he says he had the chance to buy Google and Amazon and Apple in the early days, but he did not do so. And those are lost opportunities, but he doesn't regret any of them actually. And his purchase of Apple stock much later in the day marked a difference in the trend where he was keeping away from technology, and then he did buy into Apple as a technology company. So net, yes, but the Berkshire stock has outperformed. Also, what is remarkable to note is that the cash holding in Berkshire Hathaway is now almost equal to $347 billion. That's more than 30% of his book that is being kept in cash. And Warren Buffett's style has been only to buy when there's a lot of value being offered on the table. The margin of safety has to be high, and only then he would go and make a deal. He has been very successful in such deals earlier. But the change in the current environment could be because of private equity firms. There were not as many private equity firms earlier as there are now, and these firms are able to outbid Berkshire Hathaway when it comes to buying something in value. So the kind of value that Berkshire has been accustomed to look for may not be available because there would be private equity firms outbidding Berkshire and buying such deals even before they reach the kind of stage that they are looking for. That is one of the critical reasons. And also, a point very interesting to note, Berkshire has never paid a dividend in its history since 1967. Amazing, isn't it? And that's because Warren Buffett believed that Berkshire could do better with the cash that it generated rather than give it to the investor's hand. So it is always a toss-off. Can the investor do better with the cash in his hands, or can Berkshire do better? And Warren obviously believed that Berkshire could do better. And I think he was right because his stock outperformed the index through and through. Very interestingly, right before Berkshire's CEO retiring and giving way to Greg Abel as a successor, is another article about Putin, Vladimir Putin, the president of Russia. And here he says succession is on his mind. Very strange, isn't it? I mean, there's no relation, but then yes. Putin, the longest serving Kremlin chief since Joseph Stalin, said in remarks aired on Sunday that he was always thinking about the succession and suggested that there could be a contest between several candidates. He says, I always think about it when asked about succession. That's strange. So let's actually see what happens. Further down the page, the headline says, despite falling prices, OPEC Plus speeds up oil output hikes. So Saudi and UAE have been arguing for increased production of oil. So while we think that global growth is slowing down and the demand for oil could come down, OPEC Plus actually wants to ramp up oil production. And demand for oil has not weakened significantly, they say. Oil consumption increased by 1.2 million barrels a day in the first quarter of 2025, the most since 2023, according to the International Energy Agency in Paris. Okay. Analysts there and elsewhere, though, are cutting their forecast for demand in anticipation of disruption from global trade tensions, which has already slammed prices. The prices of Brent crude have fallen 20% since April 3rd, when the US president announced tariffs on the rest of the world. That's a massive fall, 20% in just a month's time. So Saudi and UAE argue that the other countries are not keeping up to the kind of production discipline that they should. And so why should Saudi bear the brunt of production cuts? And they would rather increase production and generate a higher revenue. Remember, this is very important for Saudi because unlike earlier years, Saudi has been spending a lot on development and actually have run up a fiscal deficit, which was unheard of before. For them, this revenue is important. And the other angle to this is that Saudi and UAE are trying to be on the good side of Trump. They would like to collaborate with Trump because they're looking for deals, good deals on tariffs. And Trump's priority has been to bring down energy prices and bring down cost of living. So if increased production will bring down oil prices, they think Trump would be happier with Saudi and UAE. So that is an unsaid agenda here. Next headline says, historic milestone. India and UK seal a free trade deal. This has been in the works for a long time, the free trade agreement between UK and India, but it kept getting pushed down the priority list and could never see light of day till now. So I guess Starmer, the current UK Prime Minister, has been positively pushing this, and along with India, they've come to a good deal. And the deal actually has resulted in some pretty good things. One, zero duty. 99% of Indian exports to UK to enjoy zero duty access, which opens up the UK market for Indian exports. Okay, and tariff cuts also. India to cut tariffs on 90% of the tariff lines and 85% to become fully duty free within 10 years. So the big beneficiaries for India is there would be a drop in the cost of Scotch and whiskey and gin tariffs to drop from 150% to only 75%, and then further drop to 40% over the next 10 years. And also important is the auto tariffs to fall from 100% to only 10% under a quota. Okay. Remember, the Tata Motors, which owns Jaguar Land Rover, has its production in the UK, and not if any longer. So exports of JLR vehicles from UK to India will be much cheaper for Indian consumers. And that is something to possibly rejoice over because of the high quality of these vehicles and a lot of aficionados for JLR vehicles. Okay. And Larsen and Toubro had declared its quarterly results yesterday, and there was a 25% increase in profits, which is excellent. What is interesting to note is that the share of international orders in L&T's total order book is rising up consistently. In 2021, the share of international orders was about 68,800 crores and domestic was 2,58,000 crores. It has been going up consistently, and now as we stand, the share of international orders is 2,63,600 crores and domestic is 3,15,000 crores. Look at this, it is almost half of the total order book. And look at the volume, 2.63 lakh crores from or international, which is mostly Middle East. And I was telling you that Saudi has been spending a lot on development. A lot of orders do come from L&T from Saudi and UAE, of course. So the headline says global engines fuel L&T's order growth. Something to keep in mind. An amazing company. GST collections have risen, and one should remember not to extrapolate the April numbers, because the April numbers are always higher, far higher than March, and they stabilize again in May, June. A lot of sales happen at the end of the financial year to try and make up for losses or lower growth or pushing away inventories by manufacturers, and hence April GST collections are always higher and it falls. This has been the trend over the last 5 years. So let's remember not to extrapolate the April GST number. FMCG industry clocks 11% growth in Q1, but this is a very, very mixed number. Okay, so what is emerging is that while total volume sales have actually fallen since the previous quarter, there's a difference between urban growth and rural growth, which we have been speaking about earlier also. Okay, urban market growth decelerated in the March quarter, while rural markets saw an 8.4% volume increase, a slight dip from the December quarter, but way above urban. In contrast, urban market volume growth slumped to only 2.6%. So while rural volume growth was 8.4%, urban volume growth is only 2.6%. So this says a lot about how markets are shaping up. The confidence in urban consumers is falling because of uncertainty and inflation, while rural markets are a little more optimistic because of better monsoons there. Okay, but the entire consumption story is still clouded, and we are still not able to make out whether this will show the promise that it is supposed to be or not. Then we come down to the entire conflict that is escalating even as we speak between India and Pakistan. No doubt India has been very moderated and calculated in its approach to the conflict, whereas Pakistan is possibly feeling frustrated at its inability to control its losses, its inability to fight back. Okay, but as far as the markets go, let's try to figure out what's happening. Okay, whenever there's a conflict or whenever there's a war, the first casualty is the currency. So here also the rupee fell, and it fell almost 1%, more than 1% in one single day, which makes it amongst the top 5 drops over the last since 2022. Okay, so rarely do currencies drop so much in a day or move up or down. That's because what happens is, when a country is getting into a conflict zone, foreign investors would like to pull out and take the money out of the country to protect their money. So this causes a sale in rupees pulling down. And then one also knows that imports will shoot up. Imports of oil, imports of weapons are all going to shoot up, and that would also result in a depreciation in the local currency. So in anticipation itself, the rupee fell by 1%. Whatever gains it had made over the previous 1 week, 10 days were negated, and we are at 85.72 and even falling more. We can assume that it could fall more if the war escalates between the two countries. Okay, so while the rupee took a hit, even bonds took a slight hit. Okay, bond yields increased in the same period over just yesterday and today. And again, what happens during a war is that the governments tend to spend more and they have to borrow more to fund the war machine. And if the government wants to borrow more, increase fiscal deficit, obviously they have to pay more for that money, which is why the yields on government papers have gone up. When yields go up, prices come down. And this is exactly what has been happening. Okay. So the change in bond yields between just one day is 6 pips. It was 6.34% yesterday. It fell to 6. Rather, the bond yields went up to 6.4% the next day. And today also it is weak. And you should remember that the lowest it had gone to was 6.29%. So from 6.29, we have seen it rise to 6.4%. Let's keep a track of this carefully. The equity markets have not shown much change. They've been pretty brave as opposed to what's happening in Pakistan. Pakistani markets fell 7% in a day, hitting all circuit breakers, whereas Indian markets held steady. But today they're about 1% down, given that they are more nervous after seeing what happened last night. Okay, and we do think that this could escalate. And in any case, markets would like to play safe. There would be some profit booking on all counts, on currencies, equities, bonds. But if we look at the previous conflicts that India has been in, whether it was the China war or the wars with Pakistan and with Kargil, the equity markets never were hurt much. While there might have been a knee-jerk reaction, a year down the line, they were always far higher than where they began. So it is something to keep in mind. So do not panic in this situation. Okay. Globally, in any case, markets have been very, very volatile. They've been swinging between pessimism and optimism as we speak, because the UK has successfully concluded its negotiations with the US, and they are going to be the first country to strike a new deal and make a new agreement with the US on tariffs. And they have opened up their markets as US has demanded, and there has been some quid pro quo, but all in all, they've come to a happy deal, which makes the rest of the world think that there is a way to deal with this entire tariff issue and still come out in a win-win situation. Which is why since yesterday, the US stock markets have been up and a number of other markets have been up. Gold, because of the same optimism, started falling. Dollar reversed. Okay, so dollar was falling, and again, I think it will gain some strength again with all these developments. The Fed, that had its meeting day before yesterday, decided that it would not cut interest rates. This was mostly expected. It is not a surprise or a shock. And the Fed governor continues to say that given the uncertainty about the outcome of the tariffs, we would rather not touch interest rates now. Okay. If growth slowed down, if inflation came down, that is when he would touch tariffs. Okay. So let's keep a lookout on these numbers. Broadly, markets still feel that this year there would be some interest rate cuts. When and to what extent, I would not hazard a guess, while there are a lot of consensus estimates going around the table. So we've seen the dollar move from depreciation to appreciation. One of the significant events that happened during the week was the sudden jump in the Taiwanese dollar. Okay. Now you see, as the US dollar falls, and many emerging markets have large investments in the US dollar, they're going to feel the pinch. And if they want to make any changes, if they want to withdraw and get money back into their own country, it's going to result in an appreciation of their own currency. That's what Taiwan suddenly realized. And if it happens to Taiwan, it would happen to other countries. So many other currencies actually appreciated during the week versus the US dollar. And it would have happened in India's case also if it weren't for the India-Pakistan conflict, which brought the rupee down. Okay. So that brings us to the end of this week's wrap. Let's pray for our armed forces. Let's pray to the Lord to protect our motherland, India. Good day.